Have you ever looked at an old photo, maybe from your grandparents' time, and heard them say something like, "Back in my day, a brand new car cost just $2,000? Or maybe you've seen old movie tickets priced at 25 cents. It sounds almost unbelievable, right? You work hard for your money, you save up, but it feels like the goalposts are constantly moving further away. That $5 you had yesterday just doesn't seem to buy the same amount of stuff today. What's going on? Is this just a feeling? Or is there something real happening to the value of our money? This isn't just in your head. It's a phenomenon that affects every single one of us, every single day. We're going to call it the hidden tax. It's not a tax that the government announces, and you won't see it on your pay stub, but it quietly, steadily eats away at your savings and your purchasing power. Today, we're going to pull back the curtain on this hidden tax, understand what it is, how it works, and most importantly, what you can do about it. By the end of this video, you'll see your money, your savings, and the whole economy in a completely new light. So, what is this hidden tax? The technical term for it is inflation. We hear this word on the news all the time, but what does it actually mean for you and me? Simply put, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. In other words, your dollar buys less than it did before. That $2,000 car from your grandpa's story. In today's money, that would be more like $30,000 or $40,000. The price of the car didn't necessarily change in value, but the value of the dollar did. It weakened. To understand why this happens, we need to take a little trip back in time. For most of human history, money was something tangible. It was a gold coin, a silver piece, something that had intrinsic value, couldn't just create it out of thin air. There was a finite amount of gold and silver in the world, which meant the money supply was relatively stable. This is what's known as sound money or hard money. The value was anchored to something real. But then, a major shift happened. In 1971, the world's financial system changed forever. The United States, whose dollar was the world's reserve currency, officially severed the link between the dollar and gold. This event is often called the Nixon shock. From that moment on, our money became what's known as fiat currency. The word fiat is Latin for "let it be done." Money has value simply because the government declares it does. It's not backed by a physical commodity like gold. It's backed only by faith and credit in the government that issues it. Now, why does this matter? Because once money is no longer tied to something real, there's no limit to how much of it can be created. Central banks like the Federal Reserve in the US can essentially print new money whenever they deem it necessary, often to fund government spending, stimulate the economy, or bail out financial institutions. Imagine you and 9 friends are on a deserted island, and you use special, unique seashells as money. There are only 100 seashells on the entire island. Each shell has significant value. But what if one day a huge wave washes ashore thousands and thousands of identical seashells? Suddenly, your personal stash of 10 shells isn't so special anymore. There's an abundance of them. To buy a coconut that used to cost 1 shell, the seller now wants 10 because shells are everywhere. The value of each individual shell has plummeted. This is exactly what happens in our economy on a much larger scale. When a central bank creates trillions of new dollars, it dilutes the value of all the existing dollars already in people's bank accounts, wallets, and retirement funds. The total amount of stuff to buy the houses, the cars, the food doesn't instantly increase, but the amount of money chasing that same amount of stuff does. More money chasing the same goods and services inevitably leads to higher prices. That's inflation. And that, my friends, is the hidden tax. It's a tax because, without ever taking a single dollar directly from your bank account, the government and central bank have reduced what those dollars can buy. They've effectively transferred wealth away from savers and wage earners. Your savings are losing value every single day they sit in a bank account, earning next to no interest. The 5% raise you got at work, if inflation is at 7%, you've actually taken a 2% pay cut in terms of what you can actually buy. You're working just as hard, maybe even harder, but you're falling behind. This process subtly changes our entire relationship with money. When money was sound, it was a tool for saving. You could work, earn gold coins, and store them, confident that their value would be preserved or even grow over time. It encouraged a mindset of long-term thinking, saving, and delayed gratification. But with fiat currency and constant inflation, saving money in its pure form becomes a losing game. The incentive structure is flipped on its head. Instead of encouraging saving, the system encourages spending and debt. Why save $1 that will be worth less tomorrow? It makes more sense to spend it today. Or better yet, borrow money to buy assets that you hope will rise in price faster than the currency is devalued. This is why we see so much emphasis on investing in the stock market, real estate, and other assets. People aren't just trying to get rich. They're in a desperate race to protect their wealth from being eroded by inflation. Money is no longer a stable store of value. It's become a hot potato that you have to get rid of as quickly as possible. This creates a society that lives on debt and speculation rather than on production and savings. It widens the gap between the rich and the poor. Those who own assets, stocks, real estate, businesses see their net worth soar as asset prices are inflated by the new money. Meanwhile, those who rely on a salary and try to save in cash are left in the dust. Their hard work is devalued in real time. So what can we do? It can feel overwhelming, like we're playing a game that's rigged against us. But knowledge is power. The first and most important step is understanding what's happening. Recognizing that the money in your bank account is not a safe, long-term store of value is a crucial mental shift. The next step is to think about how you can opt out of this system, or at least minimize its effects on you. This doesn't mean you have to become a Wall Street trader overnight. It means learning about different ways to store your wealth. Historically, people have turned to assets that are scarce and can't be created out of thin air. Things like gold and silver have been used as money for thousands of years for this very reason. In our modern digital age, we also have new options. Cryptocurrencies like Bitcoin were created with this exact problem in mind. Bitcoin has a fixed supply. There will only ever be 21 million, making it a form of digital hard money that cannot be inflated by a central authority. Now, this is a complex and volatile area, and it's not a recommendation to go Ellen. But it's an important part of the conversation about the future of money and a powerful example of people trying to build an alternative to the current system. Beyond specific assets, it's about changing your mindset. Focus on acquiring skills, building a business, or investing in things that produce real value, things that can't be easily devalued. Your ability to earn, to create, to solve problems, that is a form of wealth that is much harder to inflate away than a number in a bank account. The journey of money from a tangible store of value to an abstract concept backed by faith has had profound consequences. It created a hidden tax that punishes savers and rewards debtors, encouraging short-term thinking and widening wealth inequality. It has fundamentally changed the meaning of money itself. But by understanding this, we can start to make smarter choices. We can learn to navigate this new financial world, protect our hard-earned wealth, and start thinking about money not just as something to spend, but as something to preserve for our future. It's a big topic and we've only scratched the surface today. But I hope this has given you a new framework for thinking about the economy and your own financial future. Don't just work for money. Make your money work for you in a way that protects it from the hidden tax of inflation. Thank you so much for watching. If you found this explanation helpful and it made you think, please hit that like button and subscribe for more deep dives into how the world really works. Drop a comment below with your thoughts or questions. See you in the next one.